Hi, I'm Paul Whitburn, a portfolio manager from ReCM. Today we'll be speaking about US banks and the opportunities that we've seen there. Last year I traveled for a couple of weeks through the US, visiting 20 of the largest US banks to try and understand really what's going on in the sector. It's clearly a sector that was under enormous pressure post the financial crisis and the housing crisis, and we needed to go and see what was actually happening on the ground and speak to the regulators, customers, suppliers, competitors, and all the people and businesses involved in the sector to try and understand what was going on. And really what I want to do today is to debunk some myths about the US banking sector. So one is that it's a highly risky business and they're all highly levered. This is in fact not the case. It was just the investment banks, the Goldman Sachs and Morgan Stanleys of the world that were geared at 20, 30 times that created huge amounts of risk for their clients and the market as a whole. We rather focus on the money center banks, the deposit taking banks, your Bank of Americas, your Wells Fargos. These are great banks with fantastic scale, and in fact they don't have a lot of leverage. The leverage there is under 10 times and is actually at the lowest point it's ever been. So a risk that we don't believe is worth noting. The other thing is the returns that US banks generate. The return on assets of just under 1% and ROEs of close to 10% are some of the best in the world. And this is data going back 80 years. So clearly the industry has done very well. We in fact feel that the industry may do even better going forward due to higher concentration in the industry. What has happened is through the crisis a lot of businesses have gone bankrupt and the bigger banks have become larger and the irrational competitors in the market have been pushed out. So in fact we think that those returns will probably persist going forward. The other important fact is that regulation has stepped up. Unfortunately it was a little bit too late. The regulation really came in after the crisis, and this has caused costs to increase for the banks, which has also pushed out smaller competitors who just do not have the scale and the people and the resources to compete against the largest banks. So regulation is a double-edged sword. We've got now lower risk banks because they have to hold more equity and more capital. They have to have lower leverage. So we have a less risky asset, and we believe that the returns will be the same. On the valuation side, what we're seeing there is that valuations are close to all-time lows. When we traveled there about a year ago, or just under a year ago, valuations were at about 0.8 times price to book, and we think price to book is a good measure of the value of a bank. And really that is re-rated over the last year since we've become investors. But the US banking sector is still very undervalued. It used to trade at valuations of close to 1.5 to 2 times book. So we still think it's a very interesting sector from a valuation perspective. Finally, we believe that these businesses are high quality businesses due to the scale that they possess, the switching costs that make it difficult for clients to switch between banks. The other thing is that the returns for US banks have been fantastic over the last 80 years. There have been numerous financial crises that have caused the banks not to be great investments in 1933, in the 80s, and then in 2008, 2009. But at those points, the banks were very expensive. They were trading at anything from 3 to 4 times price to book. Currently, trading at just below book, it's a totally different investment idea. We believe that the risks are a lot lower, and the valuation and margin of safety is substantial enough to warrant our customers owning large positions in these banks. I hope that's cleared up any misconceived ideas about the US banking industry, and until next time, cheers.